Hello and welcome to our latest investment update as of September 11th, 2020. I am Mark McCarron, Wescott's Chief Investment Officer. In today's update, we're going to give, as usual, a market and economic update and outlook as of today. We're going to talk a little bit about our core portfolio strategy and how it's positioned with respect to what's going on in the market, and of course, end with our current outlook. Given that it is September 11th, 2020, the 19th anniversary of the attacks on the US, we're going to talk a little bit about that impact, of course, remembering the importance of this day. All of us, I think, remember where we were and how we felt, and a recognition that the world did change that day, and really a remembrance of the friends, the family, and colleagues that were directly and indirectly impacted on that day. And there's a few potential economic relationships today in the current environment that we can point to that harken back to the feeling to some degree of September 11th, 2001. But as we sit here today, September of 2020, we take a quick look at the employment situation. The unemployment rate is below 10%. It has been improving, although the recent couple of weeks, the pace has slowed a little bit. And that's a natural phenomenon. When you drop dramatically and then rebound very quickly, the more you get back to normal, the slower it becomes. We continue to look at that because that's a very key part of the economic growth ahead, and could also drive results as we look toward November's election. The other thing that we highlighted a couple weeks ago was the Federal Reserve's policy on low interest rates and the acceptance of inflation. We're getting some indications today that consumer price indexes or inflation is a little bit higher than it was last month and the month before, but that is, again, nowhere near the target of 2%. And it was pretty clear from Jerome Powell that the expectation was that the Fed, even if they did see inflation above 2%, they would still keep rates low. And that should continue to support the economy and also the market. However, the S&P has sold off so far in September, and it's been led by the technology sector. And I think that we're going to spend a little more time in detail. Finally, the US presidential election is 2 months away, and markets will begin to learn more about each candidate's policies and begin to anticipate the outcome. What that means is that markets may be a little bit volatile. And as we said before, on this 19th anniversary of September 11th, and back in 2001, the horror of that attack and the impact on the psyche of America, but also just on individuals' willingness to go back to their normal lives. The fear that was clearly affecting every decision at the time, the unwillingness to travel back then, the real question on consumer confidence, just confidence in general, but consumer confidence, what's going to happen next, and the impact on even real estate. So would people go back to work in New York and work in office buildings again? I think what we're learning from that is that there are a lot of those same fears today in the market. The fear of the pandemic, of course, the impact on loved ones, the unwillingness to travel, the concern over spending and what's going to happen next. And of course, the real estate impact is with us today under this scenario. In both cases, back in 2001 and this year, the impact was an external impact. It was unknown and unexpected. What we did learn from that was that over time, markets and economies healed, and there were opportunities ahead. And we're hopeful as we get through this pandemic that we can return to a more normal time. But the market update, importantly, is really focusing on what's going on in the U.S. stock market and what's happening within different segments of the stock market. So the sell-off in September was clearly led by technology. I think it does highlight the risk of a concentrated market, and we highlighted this 2 weeks ago in our last update. There's a research firm we used, bank credit analysts. We've referred to them in the past, but they've dubbed the Awesome Eight, which is Amazon, Apple, Facebook, Google, Microsoft, Netflix, NVIDIA, and Tesla, as the sectors to watch. It's beyond FANG. It's broadened now, and those stocks were up 59% through the end of August, and 7 of the 8. Tesla, for example, is not in the S&P 500 index, but 7 of the 8 represent now 25% of that index. So a quarter of the S&P, its performance and its risk, are driven by just 7 stocks. And that's the concentration effect. And the valuation of these stocks is becoming very, very stretched. So the Awesome 8, if you include all of those, they're trading at 43 times earnings, which is pretty expensive, much more expensive than the overall market. And so if you take the S&P 500 index and take out the technology sector, it's trading at about 26 times earnings. And on average, the S&P has traded historically at around 15, 16, even 17 times earnings, but 26 gets expensive. It's really important to note that the Wescott portfolios are much less concentrated than the market. In other words, we're more diversified. We think that that's a better place to be, more appropriate in terms of long-term strategy, rather than concentrating into the top 7 or 8 stocks in the US market. But just one comment before I move to the next slide is, if you look at the S&P 500 year to date, or look at all these indexes year to date, through the end of yesterday's trading day, the S&P is up 4.7% still, even though it fell 4.6% so far in September. A quick look over here suggests that if you look at the growth index, which is still the technology-driven names, they're still up 21.5% this year, even through yesterday, despite the fact that they've fallen 7% roughly so far in September. The value stocks, again, these are the ones that are most affected by the fear and the uncertainty, the travel, the lack of getting back to normal, right? That's the issue that we're faced with today. So while the broad market is up, most stocks are down. And in this case, down quite significantly year to date. So when we look at what's going on in the market, we want to understand the broader market, not just the top 7 stocks. But interestingly, if you look at September, growth stocks were down much more than value stocks. It's really a closing of the gap between value and growth. And we think there's a lot more to go in that area. So where do we stand? So we want to spend a little bit of time looking at our US equity managers, particularly those that are investing in large cap stocks. So again, the orange is year to date. The blue is so far in September. The growth component of our client portfolios are invested primarily in William Blair Large Cap Growth and Invesco QQQ, both of which are still in very positive territory this year. William Blair up 20%, Invesco QQQ, in fact, up year to date 28%. Just a quick note that Invesco QQQ was actually added in March, not at the beginning of the year, and is up approximately 48% since we added it on March 25th. A quick review, the large cap strategies that we're managing for clients in general have about a 32% allocation to growth. That's William Blair and Invesco. A 22% allocation to AQR, defensive style. And just a quick comment on that, defensive equity is really higher quality, better balance sheets, and tend to hold up better in down markets. And what we're seeing in the blue bars is that the Russell 1000, or the broad market's down 4.8% so far in September, and defensive equity and value-oriented equities are down much less. And that's really what we're looking to see as the benefit of holding both growth companies and growth strategies as well as value. And one of those managers is Dodge & Cox, which is They represent really the large cap core manager in client portfolios, but they tend to have more of a value tilt. So they are willing to find value, as we say in this bullet point here, in energy and financials, which are two areas that are out of favor, not technology. They're in the other parts of the market. And they're willing to be contrarian in what we are seeing today is pretty momentum-driven market. What that means is that what's going up continues to go up, and what's going down continues to go down until it breaks. And not breaks, but it reverses, I would say. And what we're seeing here is the start, perhaps, of a reversal. And that's really why we have DFA, Dodge & Cox, AQR in the portfolio weighted the way we do to ensure that when that does reverse, your portfolios will benefit from it. The other question we're getting from clients is the need for holding bonds. It's because the Federal Reserve has cut rates to zero and is going to keep rates low for a very long time. Well, they've already been low. The rates have been extremely low over the last several years. And what we're finding is that the bond portfolios that we invest in, the strategies that we invest in, which are high quality and relatively short in their maturity, continue to produce return, even in this low rate environment. One example we're showing here is Thornburg and a limited term municipal bond. So this is tax exempt bonds, a short term focus, and a very high quality philosophy by Thornburg. For example, Thornburg over the last 15 years has generated a return of about 3.14%. Now that's pretty strong actually for a short duration bond manager. They're outperforming their benchmark, but they're also outperforming other shorter duration, shorter maturity bond strategies. And they're doing that because they tend not to lose value during periods of uncertainty. One of the things that you may be reading is that there are more municipal bond issuers either skipping payments or going into default. And that's because of the fear and the pandemic impact really on states, cities, and projects that are funded by municipal bonds. Just a reminder that Thornburg is focused on building a portfolio, a laddered portfolio of municipal bonds across the country, so they're very diversified. They have a current yield of about 1.6%. Now that doesn't sound very high, but actually if you compare that to cash, which is the red or the orange line on this chart, it's much higher, even though you're not taking on a lot more risk to get that higher yield. In particular, their credit quality, which is a measure of the risk that they take, is close to a single A, and about half of their portfolio is invested in double and triple A securities, which is comforting at a time where there's rising defaults, because the likelihood is that they're going to avoid those areas. And the areas that they're concerned about and avoiding are hospitals, nursing homes, and other industrial issuers as a result of the current pandemic. We compare this to cash because a lot of clients are asking, well, why not just go to cash? Well, first, cash money market funds are yielding 0%. There is no yield, and in fact, they're cutting their fees at the moment because they can't generate any yield. And they're the funds that are most impacted by the Fed policy. Short duration bond funds at least give you a chance to add value through yield, active management, and also credit selection, meaning what issuers to buy and which ones to avoid. And we continue to see the benefit of having a diversified and balanced portfolio that includes municipal bonds and taxable bonds for that matter. So those were some of the questions that came up over the last couple of weeks in talking with clients. We continue to think that economic conditions are improving, despite the fact that some students are going back to school, and in colleges and universities are seeing increased case counts. We're seeing high unemployment still, but that is improving slowly but surely. There remains uncertainty around whether there's going to be more government stimulus, and of course, upcoming presidential elections. So there's more volatility potentially to come, but we think over the long term, the portfolios are well balanced and prepared for it. The strength in the equity market has remained, if you look at year to date anyway, concentrated in growth stocks, but valuations are getting stretched, as we talked about, And the recent sell-off suggests the market leadership could be changing for the benefit of non-growth or non-technology strategies. As a reminder, Wescott has a balanced portfolio, including those sectors that are undervalued and a bit more contrarian. We continue to see a U-shaped recovery, and that should result in a broader market with some of those economically sensitive sectors, whether it be financials or energy or others, participating more going forward. So with that, that's our update. We appreciate, again, your confidence in Wescott. And if you do have any questions, please don't hesitate to reach out to your advisor, me directly, with any questions that you have. And again, thank you for your time and your confidence.